Hey everyone, welcome to Modern Thinking, the channel where we provide you with applicable content to utilize or start contemplating about in your life today. In order to be able to provide you with more great and consistent videos, go ahead and take a minute to smash that like and subscribe button and start taking action today. As we start the video, I want you to think about this. The road to financial freedom can be a lonely and misunderstood journey. Most will doubt you. Some will try to bring you down. But the most important matter to remember is that only you can control where you end up. So, will you make an excuse or will you do something about it? Let's start our financial journey today by understanding the power of compounding interest. Compounding interest is a strategy that all investors should take advantage of. It most benefits young investors as this strategy works better when you have a longer stake in it. Put it this way, if you start investing at the age of 20, you theoretically will have more money than if you started at 30 or 40, and so on. Let's start at the very basic and say that you turn 20 years old this year. So you open an investment account. It could be on Robinhood, TD Ameritrade, Fidelity, Vanguard, etc. In this account, you put just $200 initially in an index fund that generates an average of about 6% a year. During this period, you also add just $20 a month every month from your part-time job. That means $20 a month times 12 months equals $240 on top of your initial $200 investment. So that's a total of $440. But wait, it doesn't stop there. You will continue to earn 6% on that $440 every year. So that means you earn interest on both your initial deposit and whatever else you decide to contribute. By the age of 50, that minor investment will equal up to $20,123. But obviously, as you get older, you should have a bigger income that will allow you to invest more money every month. Now, let's compare. At 20 years old, your $200 investment with a mere $20 a month will give you that $20,123 by age 50. So by age 30, that same exact investment only makes you $9,270. At 40, a mere $3,522. Each time, nearly half of the amount is lost. So what does that mean? It means that if you get started at 20 years old, by 30, your money will double. Then by 40, that money will double again. Then by 50, that money that doubled twice before will then double again. The power of time makes compounding interest one of the easiest and most passive strategies for investors. If your money can double every 10 years until you reach retirement age, wouldn't you want that option? If you're young, be grateful and start early. You will be happy that you did. For those that do not have that much compounding power in comparison to our 20-year-old investors, have you ever thought to invest in your children? What about your grandchildren? Time and time again, we hear of generational wealth, and oftentimes people just like to talk about how, if I was rich, or if only my family had money, well, why not create that legacy? Understand the value of money and pass that on to your children and their children while also keeping values and morals true and finally breaking that cycle of non-progression. Generational wealth is passed on, much like compounding interest. It too also grows over time. Do something about it and make it happen. Now on to some more specifics about compounding interest. The power of compounding interest allows your savings to grow faster the longer it's invested. An account that pays compounding interest can be daily, monthly, or annually. Each time interest is calculated and added to the account, the larger balance produces more interest earned than before. Some examples of daily compounding interest can be found in most high-yielding online bank accounts like Ally, Marcus by Goldman Sachs, and even Discover. Certificate of deposits can also compound daily. Obviously, it's better to have a bigger capital to start with, that way you can get more money while it sits in that time capsule of long-term financial goals. But this should just be one investment vehicle anyway, so you shouldn't be too worried. Remember, this should be one of your passive investments. Now, monthly compounding investments could include dividend stocks or REITs. If you have a brokerage platform and invest in these type of assets, you could be sitting on a gold mine. In your investing portfolio, you can buy these stocks and REITs with your initial capital. Take our little $200 initial investment with a $20 a month strategy into play. As you automate your investments, you can also enroll your assets to reinvest in themselves. Just speak to your customer service representative and ask them to enroll your dividend-paying stocks and REITs into the DRIP, aka the Dividend Reinvestment Plan. This will help, as when your stocks pay you dividends, this will take that payment and buy more of the stock itself. That means you're essentially investing twice, and that will grow your portfolio significantly faster with lower tax implications. Now, annual compounding investments could include stocks and indexes where the average yield can vary from 2% to even as high as 40%. When you invest in the stock market, there is no set interest rate. The return is based on the change of value of your investment. When the value of your investment goes up, you earn a return. You also earn a return when you simply leave your money in that stock market investment, as those returns are compounded over time in the same way that interest is compounded. So, to summarize, invest as young as you can. Compounding interest is on your side. Should you decide to start, research which investment vehicles are right for you and be realistic. Most importantly, be consistent. Engrave into your mind the concept of paying yourself first. While living frugally may not seem like the best and most exciting recommendation to hear, you would be surprised the difference it makes as you get older. You can make it, and you are the only one stopping yourself from getting there. So ask yourself again, will you make an excuse or will you do something about it? If so, what do you plan on doing? Be sure to leave a comment and let's hear how we can help jumpstart your success story today. Thanks for watching, everyone. Don't forget to leave a comment, like, and subscribe to the channel and start your journey to financial freedom today.